Hi everyone, today's topic is audit risks, and I have chosen March-June 2019 question, and it asks for 8 audit risks and explain the auditor response. So if we divide 16 by 2, describe and explain is required 8 audit risks. And remember, always remember in describe, you should identify and also explain why is a risk. Never leave a risk on the exam paper without the explanation why that is a risk, because otherwise you will get low marks. As you can see when we go through the questions. So if we start from here, this is requirement done, so we skip that one. So you're an audit supervisor in a company, and you're planning the audit of the company of the audit client for the year ending 31st May. The company is a food retailer, and it gives us the profit before tax to calculate materiality. It starts with the planning meeting notes. So you are a supervisor and you met with the finance director. So the company, the audit client, has an internal audit department which undertakes cost controls testing across the network of stores. Each store is visited at least once every 18 months. The audit manager has discussed with the finance manager that the external audit team may rely on the controls testing which is undertaken by the internal department. So this is an audit risk. Why? Because you cannot just simply rely on the work of an internal department without knowing what exactly are they doing, or without knowing if they are experienced enough or if they have sufficient skills, knowledge, experience. So you should say that the risk is that it might be that insufficient substantive testing is performed by the audit team, and this may increase the detection risk and may lead to a wrong conclusion given by the external auditors. As you know, the audit risk is comprised of inherent risk, that is in the material in the financial statements, control risk, that the internal controls on to identify an issue, and detection risk, which is the risk of the auditor that might give a wrong conclusion or opinion. So in this case, the auditor is to rely on the internal control, but it might be that by relying on this, the detection risk will increase, that a wrong opinion is given. And as an auditor response, you should say that before reliance is placed on the internal controls, the external audit should get a breakdown of exactly what the internal audit are doing when testing the controls over the network of stores, and whether or not this is what the external auditor is looking for. Otherwise, they will not be able to rely on their testing. Also, if the audit internal audit department has no qualified accountants, then it might be that they're not experienced enough to undertake such substantive procedures. This is the first audit you've identified. If we move on, it says that during the meeting, the finance director provided some forecast financial information. Revenue for the year is expected to increase by 3% as compared to 2008. The gross profit margin is expected to increase from 56 to 60, which is 4, and the operating margin is predicted to decrease 21 to 18, which is 3%. So by looking at these ratios, you'll immediately see that the revenue has increased, the GP has increased, but the operating margin has decreased by 3. There is something wrong here, because the operating margin should increase in line with the revenue and the GP, because, for example, if the revenue has increased, if more sales are made, then it might be that more staff is needed, or more or longer hours. It cannot be that the revenue is increased, but the operating expenses are going down. As a risk, you should say that it might be that the classification between the cost of sales and the operating expenses are misstated. As a action recommendation, you should say that the auditor should obtain a breakdown of the expenses and ensure that they are classified correctly, because it might be that cost of sales are included within the operating expenses or vice versa. So this is the second risk. As a third risk says that the company values inventory in line with the industry practice, which is to use selling price less average profit margin. The director considered this to be a close approximation to cost. As you know, the inventory should be valued at a lower of cost and net realizable value. It might be that the method that the company is using to measure the inventory, it might be that is an attempt to manipulate figures in the financial statements. So you should say that the risk is that the inventory could be over or undervalued. So as a recommendation, you should say that this should be discussed with management, and also to review this method to ensure that this is an approximation to cost. So this is a third risk. If we move on, the audit junior attended an inventory count at one of the warehouses, and it has seen that the inventory records shown a higher quantity than the physical inventory which was present in the warehouse. So when you're attending an inventory count, you are observing what the staff is actually doing, just to ensure that they are performed as described. And the audit client staff should have record sheets from the account system showing how many items should be in the inventory in the warehouse. But the audit junior observed that these are higher. So the risk is that the inventory in this case could be overstated if figures are higher than the actually items in the warehouse. As a response, you should identify the level of adjustments between the inventory sheets from the system and the actual items found in the warehouse. And if the adjustments are high, then it might be that it cannot be place reliance on the years and figures for inventory because they are misstated. So this is the auditor response. If we move on, it says that the company launched a significant TV advertising campaign in January in order to increase revenue. The directors have indicated that at the year end, a current asset of 0.7 will be recognized, as they believe that this advertisement will help to boost future sales in the next 12 months. According to IAS 37, if an inflow of economic resources expected to the entity, then an asset should be recognized. But at this stage, we don't know if for revenue is just a simple guess, so you cannot recognize this. So you should say that this is a risk, and there is a risk that the current assets will be overstated and the profits also overstated. As a recommendation, you should say that you should discuss with management that these current assets should be expensed to ensure that the figures are correct. If we move on, it says that the company has the payroll department outsourced to an extended service organization. Previous year, and the records were transferred to the service organization. So there is a risk that when the transfer took place at the end of 2008, the figures were transferred wrongly or were not accurate, or mistakes were there, and if the initial figures that were transferred contain mistakes, then the payroll figures are not accurate. So this is a risk, and you should say as a response that for example, of the figures transferred at that time, the auditor should ensure that they are in the new system correctly transferred by matching up these from the old system to the new system. Also, the payroll service company does not have sufficient controls over the payroll function, and that the payroll figures are misstated. And as a risk, you should say that if no sufficient controls over the payroll figures, then the figures, then there is a risk that the figures reported are misstated. As a recommendation, you should say that the auditor should first discuss with the audit client if they have any controls over the payroll figures that they received from the service company, and also to request a report type A or B from the service company. So that is a response. If we move on, it says that the company is planning to expand the audit client is planning to expand the company by opening 3 new stores during July. And in order to finance this, in March, the company obtained a loan. So the company took a loan to expand, and this expansion is due to take place in July. As we know, we classify current assets, current liabilities, if they will occur within the 1 year from the end of the reporting system. So it might be that the classification of the loan is wrong, which may lead to over or understatement of liabilities, of current liabilities. So you should say that as a recommendation, as a response, the auditor should ensure that the loan is split between the current and non-current, because it might be that most of the loan will be a current liability rather than a non-current liability. The redundancy, the company is planning to make 60 employees redundant after the year end. No decision has been made as to when this will be announced, but this is likely to be in May. So the decision has not been made as to when this will be announced, but this is likely to be May. So if this is to be announced in May, because the year end is 31st of May, so this is to be announced in May, then a provision should be set up for the redundancy payments, because otherwise provisions will be, the risk is that provisions will be understated, also expenses will be understated. So this is the risk. As a recommendation, you should say we should discuss with management when the redundancy will be announced. If it's before the year end, a provision should be set up. If it's after the year end, then there should be no provision. As I said before, audit risks are repetitive, and if you practice enough the past papers or exam kit, you will be able to quickly identify the audit risk from the scenario and put the risk down, and with the recommendation, with the explanation of the auditor response. What is important in here is that you should just put down those risks that you're confident with. Often in the exam question, it will be more than, for example, here it asks for 80 risks, but we would be able to identify at least 10. So pick up those risks that you're confident with, that you'll be able to put explanations down and their auditor response, and why, most important, why is a risk. So you identify the risk and explain why is a risk, and then explain the auditor recommendation